Welcome, everybody. My name is Dan Huckabay. I'm president of Commercial Surety Bond Agency. I'm joined today with my co-presenter, Ali Salamirad from SMTD Law. Our company is a surety agency that specializes in working with contractors. We work with about 300 companies in California. And Ali's company is specializing in law for contractors, sureties, and owners. And today we are going to talk about the ripple effect of the bank failures on the construction industry. Ali and I have known each other for about 15 years, and we've gone through multiple cycles and can touch on about just every aspect of dealing with contractors and these type of circumstances. And our hope today is to give you a little insight into what's transpired with the banks, how that might impact the economy and work in construction, and some things you can do to prepare your businesses for dealing with what may to come. So with that, I'm going to hand it over to Ali.
Thank you, Dan, and very much appreciate the opportunity to make this presentation to this group. And I think, Dan, you summarized it perfectly, which is, our goal is to share with you what we see present day, try to take you back in time to share with you what we experienced the last time something of this nature had potentially a macroeconomic effect, and then ideally present you with some tools that you will be able to utilize in order to hedge your risk exposure to the various issues that we see may be impacting you and may ripple from the SVB and other potential bank failures. To start off, I think it's helpful to talk very briefly about the idea of what a ripple effect is. And since we are talking to contractors here, it's really a concept that I was first familiarized with in the context of productivity claims in your industry. And this is a portion of an opinion from the Armed Services Board of Contract Appeals that talks about cumulative impact claims, which are often referred to as ripple effects claims, because they're the ripple effect of changes, and they're not analyzed, those changes, in terms of spatial or temporal relationships. It's a phenomenon that arises at the point that the ripples caused by an indivisible body on two or more changes on the pond sufficiently overlap and disturb the surface of that body, such that, at least in the construction claims context, the entitlement to recover additional cost resulting from the turbulence spontaneously erupts. And this results in unforeseeable and indirect damage. And really, that's the focus of our presentation today. What is the unforeseeable and indirect ripple effect that may come about as a result of the failure of not just SVB and Signature and the banks that are currently on the hot seat, but potentially what are the ripple effects of a potentially broader based financial crisis. The agenda for our presentation is somewhat simple. We'll spend a few minutes talking about bank failures and the relationship between bank failures and construction financing. We'll talk in some detail about the lessons learned from the Great Recession. We'll highlight the importance of bracing for impact and preparing yourselves on the off chance that we meet a similar fate to that which was experienced during or after the Great Recession. Then we'll talk about hedging your risk exposure, which is what I mentioned earlier. What are some of the tools you can take away to your companies in order to limit or hedge your exposure to these risks? So bank failures and construction financing are definitely interrelated. This is a quote from a white paper presented by the FDIC in 2021. And this paper was focusing on an after the fact sort of post-mortem of the Great Recession and a very thorough analysis between the relationship between construction financing and bank failures. And here it says construction loan portfolios have experienced notoriously high loss rates during economic downturns. They're a key factor in many bank failures. So we know that to be the case. What's somewhat different and ironic here is we're talking about the potential flip side of this equation. Could it be that bank failures play a significant role in losses suffered in a construction portfolio? But regardless of whether it's the chicken or the egg, I think the point to take away from this is that there's definitely a correlation, a very significant one, between bank failures and construction financing. And we'll talk about why that is.
So one thing we wanted to do before kind of getting into the meat of the presentation is just touch on what's happened with the banks and give a little context. And so we've got a few charts over the next few slides to do that. And here what you see on the left-hand side is the bank deposits, and it breaks it down by the insured versus the uninsured. And essentially there's been growth in those bank deposits over the last 10 years, and you can see a significant spike when it came to the pandemic, when there was a lot of government money put out in PPP, ERC, and also for individuals. And one thing that's striking is the uninsured deposits grew significantly. So there's a lot more people that had uninsured deposits than historically. And when the banks started getting that influx of money, they had to figure out what to do with it. And they couldn't necessarily just make more loans. And so they had to take that money and find a way to get a return on it. And because it was a low interest rate environment, they started to invest in mortgage-backed securities and commercial mortgage-backed securities, which are low risk investments, but you can see the amount of money there grew significantly in terms of how much they were investing in those. And here what you'll see is Silicon Valley Bank side by side with all banks, and this is a chart of their investments. And what happened is as the Federal Reserve quickly increased interest rates, it drove the value of the investments that the banks had down significantly, because a lot of banks, what they were doing is they were going out further in duration to 5, 7, 9 years in duration on those investments to try to get a little more interest on that money. And the further they went out, it created susceptibility to interest rates going up. And as interest rates went up quickly, the value of their investments went down. And this last slide is pretty striking, because what it shows on the right-hand side is the total equity in the banks in the United States is $2.2 trillion. And the estimated unrealized losses on all their investments and loans is $1.7 trillion. So effectively, a lot of banks have had their equity wiped out. Now, hasn't been realized because they haven't sold those investments or those loans. But if they were forced to, by way of consumers or businesses withdrawing money, as in the case of SVB, when they withdrew money from the bank had to start liquidating investments. And because their investments had decreased in value and were underwater, that created a problem for them to be able to come up with the liquidity necessary to meet the demands of the customers that were trying to withdraw funds.
Yeah, and Dan, we saw just, I think earlier today, there was a report from a very significant player in the financial market that reported that there are far more insolvent banks sitting in the marketplace right now than that the marketplace is currently aware of, and it's for the very reason you described. Right. It's really an accounting process. How they mark their investments in securities, and if in fact those securities matured and needed to be liquidated, or if they needed to be accounted for differently. I think what we know is that the landscape for many of the banks is much more problematic than maybe what they're presenting to the public generally. And that's reflected in the 1.7 trillion out of the 2.2 trillion as being an estimated unrealized loss. This is a
Right.
figure that is, it's a chart that tells us a lot of stories, quite frankly, but a few I think we should focus on. This tracks construction spending in billions of dollars over the course of decades since 1960. Obviously, I've highlighted the basically 2008, 2009, 2010 timeframe, which represents the downward movement in construction spending that was affected as a result of the Great Recession. We have a question mark, obviously, which is the big question, which is what happens now to construction spending. If you'll notice, over the last 10 years, it started to improve, and it's been a steady, gradual increase in construction spending since the lows of 2009 and 2010. However, it's taken quite a bit of time to get back to where we are. And if you'll also notice, the peak of where we currently are is not yet at the peak of where it was before it failed in the first place in 2009. And in fact, it's less than several peaks that preceded that. So we're not in the best of positions now, but clearly over the better part of the last decade, there has been a gradual improvement in the amount of money being spent on construction. And it's differentiated between single family residential, which is in the green, and then the non-residential or commercial type money, which is the red dotted line. A couple of other interesting things to note here, as you saw, or you will see, if you look right before the 1980 mark, that significant downward movement in construction dollars being spent. Well, that's the 1978, 1979 heavy inflationary pressure situation at the end of the Carter administration, which then led to or transitioned into the Reagan administrations and Reaganomics. But not a coincidence that with those high inflation rate pressures and the effect of those rates on the macroeconomics of the country, there was also a very steep decline in the spending on construction projects. The chart you're looking at now does not reflect any real impact of increased inflation rate as of today. So it doesn't reflect that. That's what the question mark is. Nor does it reflect the possible impact of the failure of several or significantly more banks in this country. What we know is that latter part of September of 2008 is when Washington Mutual collapsed. In Washington Mutual, as many of you know, is referred to as WAMU. They were later acquired by Bank of America. And what we know is that after the collapse of Washington Mutual, there was a catastrophic effect on regional banks. And this is regional banks in particular. And we'll look at 2008. And what we're really talking about in 2008 is 3 months. So it's not a very significant period of time. But in that 3 months in 2008, there were 12 regional bank failures. That in and of itself is a historically significant number. There are very few years where there have been that many failures. And in 2008, in 3 months, there were 12 bank failures. In 2009, there were 139 bank failures that have been identified by the FDIC. In 2010, the number reached its peak at 153 banks that failed. And then as it began to calm down with respect to the failure of our banks, in 2011, we had 91 banks. That is a lot of bank failures. So we don't use the word catastrophe lightly. What we know is the collapse of Washington Mutual and the macroeconomic impact of that collapse resulted in a catastrophic impact on the smaller regional banks. And if you think of each of these banks as one in which it serves its own region, its own specific small and family-owned businesses, each of those banks has multiple branches, locations, and then you expand that one footprint for each bank to the numbers that we're looking at here, you can see that there was a significant depletion to regional banks from the time period of 2009 to 2011, 12-ish. We also know that after the banks recovered, well, a lot of them simply left the market. But we know that from the period of time and right around 2017 and 2018, there really hasn't been a lot of turmoil in that banking marketplace. So the rebound has resulted in what we refer to as the calm waters. From 2018 until the present day, including the two banks that we know have failed as of today this year, there have been in each of those years less than 5 bank failures. So the waters have been quite calm. The trends we looked at in the last few slides are they're basically parroted in this snapshot of the stock price of an ETF that covers basically regional bank stocks. And as you can see, beginning in 2008 and all the way through the middle to latter parts of 2013, those regional banks were under significant price pressure, and their stocks did not perform, and their stocks lost value consistently. That began to improve 2014, a steady, again, gradual increase in pricing of these stock issues over time. You saw a dip in that time frame for COVID. We'll see that dip in other charts that we're going to be talking to you about here today. And this is just to basically show that the market has been basically tracked when they're putting value to these regional banks. The market has tracked the price of those banks, and the trends have been consistent with that of construction spending. There's a concept called the discount window that's been in the news quite a bit in relation to the banking issues that we're talking about here today, and it's referred to in this slide as the ominous discount window. And I think Dan and I both think it's important to understand what the discount window is in order to get really the full context of what we believe the type of turmoil actually is that some of our banks are experiencing as we sit here today. So the discount window is a direct lending facility that the Fed has available to it to support and stabilize banks of all sizes by infusing liquidity and providing them with immediate access to capital so that they can meet their obligations to their clients, their depositors. The loans from the discount window are due and payable basically net 90. Some of those loans can be extended at the request of the borrower, but the term of these loans it's really a short-term loan. These loans are popular at moments of distress because if a bank has gotten to the point where it's seeking money from the discount window, it's very likely that it's not able to get funding anywhere else. It's not able to borrow from other banks, and it's not able to generate capital by liquidating collateral security in a way that allows that bank to maintain its operation with sufficient cash flow. What's important is, in order to tap into the discount window, these banks need to pledge collateral. And that collateral takes the form of government bonds, other forms of assets that may be more longer term in nature, but that the bank pledges as collateral. And if the bank is not able to repay the government the monies that it has received under these loans from the discount window, then the bank loses that collateral. This is a figure that is staggering. It's a reflection of the borrowing and the usage of and from the discount window from banks from 2003 to 2023. You will see that the discount window really has not come into play but for 3 instances in our recent history. Number one, you'll see the significant access to capital from the discount window in the year 2008, 2009, a slow and steady and gradual reduction in access to those monies into 2010, latter parts of 2009. We saw an immediate bump up to access to the discount window at the onset of COVID. It balanced itself out relatively quickly in that 2019, early 2020 period of time. The figure you see, or the portion of the graph that you see at the right, which is that straight vertical line up, is not a mistake. That is not a typo. This is what Bloomberg has published that shows that there has never before been such a significant accessing of the discount window funds by banks in the history of the discount window. And not only has it been meteoric in the pace at which those funds are being sought, but the amount of money in billions of dollars greatly exceeds the totality of the money that was sought during the last Great Recession. And that is money that was basically tapped into and sought in a very short period of time, whether that be days, a week, or potentially longer. But we're not talking about a long window from when this line started to move north and to where it is today.
Yeah, and something I would add to that, Ali, is this problem that banks have with their investments being so underwater is not a short-term problem. Until the Fed reduces the interest rates to what they were, if they reduce them to what they were, the banks will likely have assets that are under the value that they purchased them at, which is going to leave a hole for possibly quite some time.
Yeah, that's absolutely right. And so there's a lot of jockeying and back and forth between those sectors and their lobbies, right, as to what the next move should be and whether or not the Fed is taking seriously the potential that its actions are really undermining the stability of the banking system, which is really not something the Fed wants to be doing. But at the same time, by identifying inflation as the number one enemy of the economy, it just may be that a victim of that approach is the stability of the banking system. And maybe not the stability, Dan, of the entirety of the banking system, but maybe the breadth and the width of that system. So there may be a contraction of the banking system as a result of what we see having occurred and maybe occurring here in the next several months or years.
Sure.
So Silicon Valley Bank didn't get a discount. And this was interesting because just this week, Michael Barr from the Fed was testifying before the Senate, and he described in great detail the work that the Fed staff did on March 9th to save Silicon Valley Bank. And he described this as them searching for enough collateral to borrow the additional billions of dollars from the discount window so that that bank could honor the withdrawal requests. They weren't able to do that. And so the bank wasn't able to meet its obligations to pay its depositors over the course of the following day. And as soon as that became a reality, there was no choice but to shut the bank down entirely. The bank couldn't meet its obligations to its clients. They could not satisfy requests for withdrawals. And that is a frightening thought. And it's further frightening to think that the Fed had within its toolbox this emergency fund direct lending facility. But the financial situation at this bank, this large bank with billions of dollars at risk, that the Fed couldn't even utilize that last ditch discount window to keep this bank from failing. One of the questions I think that we ask of ourselves and of you in listening to this is Silicon Valley Bank the new Washington Mutual? Is SVB the new WAMU? And they're certainly not the same on paper. We know that WAMU was burdened with the mortgage-backed debt. We know that WAMU was burdened by an economy that was hyper-focused on extending mortgage credit to folks that probably shouldn't have been getting mortgage credit in the first place. And there were not measures in place and underwriting standards and guidelines in place that controlled the issuance of that mortgage paper without allowing it to get completely out of hand. And then those mortgages were securitized, and it just led to further and further problems. Now, SVB, as far as we can tell, wasn't necessarily burdened with that mortgage debt in the climate of overriding mortgages, but it certainly appears to have also been burdened by irrational exuberance. An irrational exuberance in the sense that the bank and its management and its underwriters and its board appeared to have thought that investing and basically funding technology companies and everything that those technology companies wanted, that was a low risk proposition, because technology companies were the future and they appeared to be on the cusp of making a lot of money for all of their investors. But they were highly concentrated in a particular market, just as was Washington Mutual. And then SVB had really the death knell, which was, I think history will find, one of the worst investment decisions by a company of its size, where they failed to get credit swaps to protect themselves from the long duration of the bonds they had purchased to try to make money on some of their deposits. Regardless of why they failed, I think I'm certainly suggesting is maybe it doesn't matter. Maybe it doesn't matter why SVB failed in comparison to why WAMU failed. If the net effect is that there is some form of contagion and there is some form of credit crunch, then why those entities or banks failed may not be as important as to what happens when they did. And I don't think that our Fed believes that it matters either. In recent testimony, Fed Chair Powell testified that financial conditions seem to have tightened. That refers, I think, to the credit crunch. And they tightened more than traditional indexes led them to believe that those conditions would tighten. And the Fed's going to be looking to see how serious it is and if it's going to be sustained. And I think what's important here is you have the Fed chair telling us if it's serious and sustained, it could easily have a significant macroeconomic effect. And then we, the Fed, would factor that into our policy decisions. So you have it from the horse's mouth. The Fed is telling us that if in fact there is a tightening of credit, and if that tightening is serious and sustained, it could have a significant macroeconomic effect, just as the failure of Washington Mutual ended up having a significant macroeconomic effect on all walks and parts and components of our economy. So credit crunch and that tightening, just very briefly, that it's when economic conditions make financial organizations, whether that be your banks, bonding companies, all financial organizations become less willing to lend money. And when they become less willing to lend money, it often causes serious economic problems. For you as the contractors, that certainly affects your access to your working capital if you rely on financing in any form to support your day-to-day working capital, your operations. It also impacts construction loans, which on private works at least are the lifeblood of the work that you do. Those construction loans need to flow freely. They not only need to support the projects that you're currently building, but they're necessary for your backlog. And it's necessary to know that the jobs that you have in your backlog are actually going to get contracted out, and they're going to get built. And whether or not there's a credit crunch may actually impact the result of those several questions. So the bottom line is a credit crunch would impact cash flow from top to bottom, left and right, every which way. So we talked about earlier, but really what we want to do by going back in time a bit is share what we believe might be some lessons learned, in hopes that by getting out ahead of this at this point in time, you, your management teams, your companies as a whole can first of all understand what may be coming. I think that's important, but also take the lessons learned and what history has told us may be the actual impact to your industry, and plan and implement measures that are going to assure that your companies successfully not just survive in a market that may become tumultuous, but thrive. Because in every tumultuous market, there still are winners. And those winners are the ones that planned for it before it happened. And I think Dan and I would agree unequivocally that those winners are the ones that implemented measures to anticipate issues before they came up, and dealt with issues on a real-time basis as they were being felt by the companies. So what we really want to do is avoid being insane, right? We do not want to do the same thing over and expect a different result.
Yeah, Ali, you put it really, really well. I mean, I think what Ali said, we want to avoid our contractors putting their heads in the sand. And there's proactive things that can be done here. And what we're going to do over the next few slides is really look at the state of the construction industry going back to 2008, how that transpired, and what it looks like today. And then we'll kind of get into some, the risks that contractors and surety companies face. And so these next few slides are based on data from our clients. Like I mentioned, we work with about 300 contractors in California, and we compile their financial data and we take a look at the trends. And so we're going to kind of share that with you to give you some insights, hopefully, that will help you see what might be forthcoming. Here on this slide, we've got the percentage of our customers that had a profit in any given year. And if you look back at 2008, which was kind of the peak, 92% of our contractors were profitable. But then you see that trend go down in 2009 and 2010 to where it bottomed out, just over 50%. And over the last, 10 years, it's made its way back. On the right-hand side, you can see the red line is the operating profit for our contractors, meaning without PPP or employee retention credits. And the green line includes that. And you can see the last few years, contractors have definitely been impacted. I'm sure all of you have faced your challenges, whether it be with material prices or job delays or things of that nature due to the pandemic. And it's contractors are just getting out of that. I would say it's by no means back to where it was in the mid 2015, 2016, but it's getting close, in terms of profitability.
Yeah, one thing I just sort of parrot what you shared, Dan. The spread in the circle you have there on the upper right-hand corner of this slide, the spread between the green and the red, right? That is the spread generated by the federal government. That is government assistance.
Yep.
And if we look at the green line, I think that would track pretty similarly to sort of the individual in this economy and to companies and businesses throughout the economy, in so much as there is this sort of artificial comfort that has been created over the last several years that we can't ignore exists, because the reality is, but for all of that government lending and support, we would have been walking into what could be the next crisis in a much more precarious situation. And I think it's fortunate that that's not the reality, such that there was support. But there's no other time in this chart, Dan, where you can see there's that level of government propping up. You know, there is a little bit of it between 2010 and 2012, but pretty much those lines coexist with one another, and the spread is so significant. The fear, I think, that we'll talk about a little bit more, is that when all of that money has run out, you know, what happens to reality and what happens to the red line? And what would have happened to that red line without a problem with the banking system is a question in and of itself. What happens to that red line if you have your other issues and you exacerbate those issues with a banking crisis, I think, is the question that we're fearing the answer of.
Yeah, I think that's a great point, Ali. And the other thing I would say along with that is we're going into this where fewer contractors today are profitable than they were going into the Great Recession. You know, so there's already some vulnerability, and while the government money has run out, not all the problems are over from the pandemic in terms of, you know, the material prices and delays and things like that. So we've got a couple of forces converging on each other. On the positive side, you know, contractors, this chart shows backlogs and gross profit margins, and you know, in 2022 the backlogs and profit margins are pretty good. So contractors are going into this potential downturn with good backlogs and with good margins in their work. You can see on the left-hand side how, just like the last slide, it took a couple years, you know, going from 2008 to 2010 for that to kind of bottom out. So contractors, and you're going to see that same trend consistently through each of these slides. There's a little bit of runway, and that's why we're trying to get this out now, because contractors do have some options right now. Here you'll see the average net profit margin of our contractors, and here what I want to focus on is 2010. You know, in 2010, where it bottomed out, our contractors lost on average 4%. And keeping in mind that's an average, so that means some people lost more, some people lost less. But if we assume that the average is going to stay consistent, then I think what contractors have to ask themselves, one is, can we avoid losing money in the first place? Can we do things proactively to not be in that position? And we'll talk a little bit more about that later. But the second part is, do I have a balance sheet that can withstand a 4% loss? And hopefully it's only 1 year, but what if it was 2 years? And those are the types of things that I think it's important for contractors to consider right now. So in terms of, you know, risks for the construction industry, one of the things that came to mind to us is, have things changed? Is it safe for companies to keep all of their cash at one bank? And this is a challenging question, and I don't think we have an answer to it, but there's definitely every contractor, I think, needs to give themselves this thought, because, you know, what if all your deposits had been with SVB? You know, where would you be? Where would your company be? And what if your deposits are with the next bank that fails? It's tough for contractors because the small to regional banks are typically the ones that lend the most to contractors. There's very close relationships. We bank with a regional bank, so I certainly support regional banks and believe in them. They're certainly not all equal, though. And it is incumbent upon each of us as business owners to know who we're banking with. And so does it mean we got to spread our cash out? Does it mean Ali and I learned of something earlier this week about a program some banks have where I think it's called a sweep account, where they can, not necessarily related to a line of credit, which I think is what most people think of it in terms of, but it actually is where banks have relationship with other banks, and they will take, say, $1 million deposit and distribute it to those banks evenly to stay under the $250,000 FDIC limits. They get charged a fee by the other banks, but it's a way of spreading money out. The other question is it safer to keep your money at banks that are considered too big to fail? There's some people that would think that, say the government's not going to let a JP Morgan Chase, go down. And so it's safer to keep money there. I don't know if that argument ultimately holds up, but certainly a consideration. And the last thing I'll touch on here is brokerage accounts. Brokerage accounts do work differently. When you invest your money in a treasury or stock, a brokerage account is holding it as a custodian of that money, and they're not lending it out. They are supposed to just hold it for you. And so there's a different element involved there. There's been very, very few losses with brokered accounts in the history of the United States. And those accounts, we put a link there to some information. They are insured up to $500,000. So again, another consideration.
Yeah, and one thing I'd add to that, Dan, is just this week there's been quite a bit of discussion about the instability in the life insurance market. And it's not really a direct risk that would come to mind for this group, but I think it's something just to be aware of. And that is, life insurance companies, for whatever reason, have had or do have a significant direct exposure with money that they have invested, not just with SVB, but with other banks that are considered on the watch list by Moody's. And as a result, as a sector, their stock prices have fallen something in the range of 20% across the board within the last 7 or 10 days. So they're coming under a lot of pressure. That impacts you all, not just, being worried whether or not your policy is going to, the carrier is going to fulfill its obligations under your policy. But in the event of a liquidation, which is what happens to a life insurance company as opposed to a bank, it's more similar to what would happen to an insurance carrier that goes under. If the state were to take over a life insurance company, it's an entire liquidation process. And the end result really is whether or not there are enough assets that can be liquidated to create enough capital to satisfy that carrier's obligations. And that could also impact your relationships with sureties and or others you're borrowing money from, because oftentimes you identify your life insurance policy as an asset, depending on the type of insurance it is. So it's just something to keep in mind, that there has been this somewhat imbalanced impact on the life insurance sector and their reinsurers that may be in the news a bit more than expected in the coming weeks.
So some other risks that contractors need to consider is really the ability to access capital and loans. And Ali kind of touched on it earlier with the credit crunch. And to expand on that a little further, regional banks are typically more aggressive lenders than the larger banks. And what I mean by that is they lend more of their loans, or their deposits, I should say, as a percentage than the larger banks do. So a small regional bank might loan 90 cents of every dollar they have in deposits, whereas the large banks might only, like JP Morgan Chase, for example, I looked theirs up, and they loan about 50 cents on the dollar. And why that matters is money is flowing out of these small and regional banks to these larger institutions. And there's kind of a twofold reason. One is, Ali and I were just discussing an article today, and one part of it is people are searching for return on their money. And so some people are moving money to brokerages and things of that nature to get more interest on their funds. But another reason is that idea of too big to fail, and is it safer to have your money at these larger institutions? And there was a news article I read that I think it was Chase again, that said about $560 billion has moved out of the small to regional banks to these larger institutions. And so effectively what that means, if you have a bank that at one time had deposits of $100 million and now only has deposits of $50 million, and they're lending based on either having 100 or now only having 50, they're going to lend less money. And you combine that with interest rates being higher, and banks are overall going to tighten their underwriting standards, partially because they don't have as much money to lend. And the other part is they have to evaluate whether the deal they're looking at actually makes sense given the higher interest rates, and on top of that, the uncertain market conditions. So that could create challenges for contractors when it comes to either trying to increase lines of credit or get lines of credit, and sometimes it may even be a challenge in renewing a line of credit. So these are all things that we hope you and the audience are just to make you aware of, and that way you can be proactive in your discussions and not get blindsided if these things should change. The other element of the higher interest rates and the credit crunch is some of these private projects are no longer going to pencil out. And we've already heard, from our contractors about jobs getting shelved for the time being. As the economy contracts, obviously that lowers tax revenue, which directly impacts public work. And then you have a competitive factor. If the private market shrinks, what we've historically have seen going back to 2008 is a lot of contractors get into the public market. There was a time where I remember seeing results on a bid. It was common to see 20 bidders, but there was one time we even saw 50 bidders, and you got to question yourself whether that's a project that you want to get at that point. There is some good news compared to 2008, which is this go around, there is infrastructure money that has been already funded by the federal government. And back in 2008, when it was created and approved, it took a year to get in place, and then it took time to get the funding out. So we were already pretty deep into the recession by the time money started actually flowing. As everybody knows here, the IIJA was already approved, and in California in particular, $14.5 billion has already been allocated. This next chart here shows the amount of money that is projected to be spent by the Federal Highway Administration funds, and again, it's positive. There's a steady amount of allocation for Caltrans projects.
And just touching on what you were just talking about, Dan, which is some potential good news. Unlike 2009, where after the collapse of WAMU, the government got together and infused capital under the American Recovery and Reinvestment Act. Here we have a situation where the IIJA, which is the Infrastructure Investments and Jobs Act, was already in place prior to the SVB failure. So hopefully that will result in what? I think ideally it will improve the pace at which if there is a drop, and if there is a reduction in construction spending as a result of credit crunches or otherwise, then perhaps the fact that all of this money is already allocated and earmarked for infrastructure improvements, perhaps it speeds up the amount of time it would take to get back on track. Because if you recall from the slides we looked at before, after the Great Recession, it took about that decade to basically recover from the loss of expenditure that was suffered as a result of the impact of the WAMU collapse. So hopefully, as a result of having these programs in place now, it'll have a lesser impact on your business as you see it on a day-to-day basis with respect to what type of work and what type of money is out there.
Yeah, that's a great point, Ali. To that point about the impact on the market, one of the best ways to look at the market is the bidding. And, I already touched on earlier that margins have held up so far. And as far as the bid activity, the slide shows the number of bids our customers have done. But more importantly, the red part of the bar is the percentage of low bids. And right now our customers have been averaging low bids on about 30% of their jobs, so every 1 out of 3 jobs. So that is an indication to us that it's still a pretty healthy market in terms of bidding, in terms of the number of bidders. We probably on average see anywhere from 1 to 5, maybe up to 10 every once in a while, but the number of bidders hasn't dramatically increased. So the balance of essentially contractors to public works projects is still in pretty good shape.
Yeah, and when we talk about a migration from private to public work, which is absolutely what we saw in the 2010, 11, 12, and 13 timeframe, we should expect and will see an increase in bidders, and it has multiple impacts on your business. I mean, first, if you're not getting as many jobs as you were before that you were bidding, I mean, there is a fixed and significant cost associated with bidding jobs. You have your personnel, you have the time, and all of those folks are spending time doing things that aren't generating money. So that's going to impact your margin, period. What's worse is, and what we experienced in the Great Recession was, over time, when our contractors weren't getting projects, unfortunately, some of their solutions to that problem was get more aggressive, sharpen the pencil even further, and make sure that we get those jobs, because the mindset was, and still is in many instances, we have good people, we don't want to lose them, we can't operate and we can't sustain our business unless we get the jobs. Well, in order to get the jobs, the contractors who were getting the jobs had to price themselves out of sustainability. And there were example after example, particularly here in Southern California, of contractors who did just that, many of whom actually left the private works arena, right? They were doing that subdivision work. They were making a lot of money when the housing boom, supported by the mortgage industry, resulted in a lot of cash. They made the migration thinking it wouldn't be that big of a transition to go from private to public. They realized they'd have to lower their pricing to get the jobs. They did it. So they had all the backlog. They might have had 40 bonded projects on their books. But because there wasn't enough money in those jobs to support the operation, the entire thing failed. And because they weren't used to payment terms on public projects, where in the past they expected they would submit a bill and within 2, 3, 4 weeks, the owner would pay them. There wouldn't be problems with labor compliance. There wouldn't be problems with stop payment notices. There wouldn't be problems with owners refusing to pay for work because the owner didn't feel like it for whatever reason. All of the problems associated with bidding and performing public works were, they were not known to that client base. And so if we see that happen again, the fact that there's more bidders, yeah, that's bad. But the reality is, who gets those jobs could actually be worse. And I think that's what Dan was referring to, which is when you've got 25 bidders on a public project that's being let for $5 million, do you really want to be the company that gets that job?
Totally. And then we wanted to touch on, the risk for the surety industry. And part of the reason we want to touch on this is because just like banks, you guys depend on the surety industry to give you bonds. And a lot of people have never really experienced a market where the surety industry is tight, like after 2008. The surety industry really hasn't been tight since the mid 2000s. It's been fairly accommodative of contractors. Sureties obviously bear the risk. Everything that you guys are going to undertake by going through any kind of market downturn or dealing with the banks, the sureties are going to deal with that too, because if you don't have a line of credit, it impacts their risk of your ability to cash flow. One of the other risks is some contractors have never experienced the downturn, and there's something to be said for experience in going through these things. Once you do it, you get an idea of how bad they can be, and the belt tightening that really needs to happen. Sureties also have a lot of exposure that most contractors don't really realize, relating to a lot of other bonds in the marketplace. But one of the things that they do on occasion is get letters of credit from banks. And one of our sureties, for example, had 17 letters of credit from Silicon Valley Bank. And so that means potentially any claims they get on those bonds that they thought were secured may not actually ultimately be collateralized.
Yeah, those are letters that you all are procuring from your banks, right?
Right.
That in order to get collateral to satisfy the underwriters at the surety to get one bond or several bonds in your program, the surety is asking you to get a letter of credit. Well, depending on your bank and depending on where you are in this country, oftentimes that's a fully collateralized letter of credit. So in order to get that letter of credit to provide to the surety, you will have had to post something close to the full value of that letter of credit, whether that's in the form of cash you're holding at the bank, or perhaps you're investing with an arm of the bank. So you're pledging your securities in exchange for that letter of credit. So it's a very significant problem if the surety has an issue with your letter of credit, and you may be required to provide an additional letter of credit or replace that letter of credit. So the risk to the surety is that it loses the liquidity in the letter of credit. The risk to you all is you lose the collateral or access to the collateral that you posted for that first letter of credit, and you may be required to post an additional letter or provide additional collateral security, which in effect would require you to double the collateral you're posting or were required to post in the first place.
Yeah, and then the other kind of exposure that surety companies have is they provide depositor bonds to bank, and essentially what that's for is for banks where they have deposits in excess of that FDIC insurance. They get these bonds in order to make people comfortable that, hey, we've got these bonds that will essentially benefit you or pay you if the funds are in excess of the FDIC coverage. The concern with that from the surety's perspective is now they've got liability to these banks, and if the banks fail, that could impact the surety companies. And bringing this back to the audience here, why that matters is if sureties face losses as a result of these things, they're going to be like the banks and tighten up their underwriting. And there may be some underwriting tightening that already happens just because of the state of the market. Sureties might, knowing that there's a downturn, they're going to want to make sure that the contractors they're underwriting have the ability to weather these potential challenges. But then if you add on top of that, surety companies getting impacted by losses on other bonds not directly related to construction, it kind of compounds that problem. One of the other areas that I would say surety companies have kind of a lot of risk out there today, more certainly than they ever did previously, is there's a lot of private equity companies that have been buying up contractors. With the state of the market of aging demographics of a lot of contractors coming to retirement, one of the ways contractors have found to exit their business is to sell their company to private equity. Well, private equity, a lot of these models are built on 5 to 7 years holding a company, and then they plan to sell it, and they use debt that is structured in that same time frame. And if they purchased a company when interest rates were really low, and now they've got to either sell or refinance that debt, their equity or value of that company that they bought could be significantly lower. And what happens when private equity companies run into that situation is they just wipe their hands and move on, because they don't have any personal guarantees like most of probably the people in this audience do. And so that is another area that creates a lot of vulnerability for surety companies. And the last thing I would say is, surety companies, I always compare this to the banks leading up to 2008. The issue, it's so obvious looking back now with the banks leading up to the Great Recession, where people were getting, no documentation loans, or, had really low credit scores and not enough income to even cover the debt service, but still could get the loans. And the surety industry is in some ways doing the same thing. I wouldn't say to that degree by any means, but there are certainly contractors that many years ago would not have qualified for bonds. They don't have the fundamentals. They don't have working capital. They don't have bank lines of credit. They got poor personal credit. Yet they've still been able to get bonds. And contractors that are in that position going into a downturn are much more susceptible to have problems, which again creates then losses or potential losses for surety companies. And that ultimately works its way around to those contractors that are well heeled because the surety companies tighten up their underwriting standards for everybody.
Yeah, and one thing I'd add there, those are excellent points, Dan, on the depositor bonds, because it may be of interest to some in this audience. So because the depositor bonds are really, they're in effect a marketing tool, right? The bank provides this as an offering to high net worth individuals or companies who are concerned that their deposits with that bank aren't covered by the FDIC insurance at $250,000 an account. And there's some specific rules as to multiple accounts at the same bank, the entities that are holding those accounts. There could be a whole presentation on what is and what is not insured. Putting that aside, if you are holding a significant amount of cash at a particular institution, and you know that that institution does not want you to move your cash to JP Morgan or some other institution, this is the type of thing you may ask your banker for. Okay, I have a concern that I'm holding $5 million of cash with you. You are a regional bank. I trust you all. I'm looking forward to doing business with you all going forward. I want to stand by your side. But I'm concerned that if something catastrophic were to happen, I could lose $4.75 million. So I heard about this thing called a depositor bond. Is that something you would be interested or able to provide to me, pay for and provide to me? Because you are what's considered, you would be the, whether it's you as a contracting company or entity or you as an individual, you would be what is considered the obligee under that bond. And so you're the beneficiary of the bond. So the bank is going out and they're getting this bond for your benefit. So if, I guess if you're fortunate enough to have, to be in the situation where you are actually holding a lot of cash at one particular institution, and if you're scratching your head as to the earlier question Dan addressed, which is, do you keep your eggs in one basket? Do you spread it around? This may be a question to ask your banker. One of the, and we touched on this earlier, but those irrevocable letters of credit, not lines of credit, letters of credit, immediate decisions might need to be made by, really, it's whoever you have provided that letter of credit to, or if someone has provided it to your company. But the question really is under an ILOC, does the beneficiary, does the holder of that letter of credit draw it down right away to protect itself if that letter is issued by a bank that is either in immediate danger or one that's kind of on the radar for being in danger in the near term? Does the holder of that letter draw it down and do something else with the money securely? Does the holder of that letter talk to whoever had it issued by the bank and say, I'm giving this back to you. This is no longer the collateral that I am comfortable with. So I'm going to give it back to you. You do whatever you want with it. I need new collateral. So these may be discussions that you're having with folks that you have credit relationships with. And if it is, I think these are some of the issues that you can anticipate anticipate having to discuss with them. Talk relatively briefly about risks to our owner and developer clients. At our firm, we do quite a bit of that work, and it's usually in distress situations, and we get asked to come in when projects are in distress and assist in getting those projects completed. But the risk to owners now, I think it's obvious with respect to access to capital, right? Do the owners, do the developers have access to funds to complete their existing jobs? And what about access to funds that they were anticipating, for their own pipeline, for their backlog of development projects? That's all. It could be at risk with a tightening in the credit markets, right? So it doesn't have to be that the bank that was going to loan that money is one that is no longer there. Does the macroeconomic condition impact the availability of credit to what we already talked about, what is otherwise considered a relatively high risk portfolio? So could it be that banks just begin to tighten lending for construction financing? Alternatively, and we had a question, I think, the other day, which is, have we seen banks pull that credit? Have we seen banks come in the middle of a job and say, we're no longer providing you with this financing? No, we haven't seen that. It would be somewhat surprising if that were to happen. But what you may expect to see as an owner or someone as a contractor working with an owner is that the banks might be a little bit more aggressive in enforcing the terms of their loans. They may be more aggressive in their discussions with the borrower about extending those loans. They may be more aggressive with the borrower with respect to whether or not the borrower has violated any covenants under their loan agreements. Ways in which the bank cannot officially pull their money off of the table, but by taking certain actions to enforce their rights as the lender, the bank could shrink and otherwise mitigate its exposure to this particular portfolio, which is construction financing, which would not be a good thing for owners and developers. And then obviously, we'll talk about this in a bit, but, the owner's liability to you as the general contractor and to others for the work that's performed on their jobs is not contingent upon their ability to get money from a bank. So, if a project goes south, if promises are made to contractors, to investors, to others for future projects, and if the owner can't satisfy its obligations because the funding has either dried up or it's limited in some significant way, the owner itself, he or she's going to have liability downstream. And I think it'd be difficult to avoid, becoming insolvent if you have all of those liabilities, but you don't have access to the liquidity that you were expecting on the revenue side of things. So the last point, I think, is an interesting one, because we're talking about adding these potential risks to what we already know is a fragile marketplace. So according to this very recent publication, banks have $270 billion of commercial real estate loans coming due this year. Of that $270 billion, $80 billion of it is tied to office space. And this author, or this person being interviewed in this piece, says, we are extra concerned about that, about the office space exposure. And why is that? Well, we already know, putting aside any of the additional risks of a ripple effect that may occur as a result of bank failures, we know that office space as a concept, as an entire construction phase, not only of yet to be completed, but currently in the process of being completed work, it's at risk because of demand, right? Because of the shift in what the consumer is demanding, the lessors of that space are demanding, and the shift from working in an office to working at home or some sort of hybrid models. There's already such significant pressure on this market. And the question then becomes, could commercial real estate be the next shoe to drop as a result of these regional bank failures? And could that shoe drop because they're already so susceptible? And if you add this added pressure of a credit crunch, can the developers and owners of those properties really withstand that level of stress? So bracing for impact is really what we want you to take away from this as some practical tips that you can keep in mind with the goal of mitigating risk exposure. So we can all hope for the best. And I'm a big fan of optimism, but what we know for certain is that those who are going to thrive and succeed in a troubled market are those that plan for the worst, period. So like Dan was saying, we want to avoid folks thinking it's okay to bury heads in sand. Absolutely correct. That does not deal with the problem. Most of these problems they're capable of being dealt with or at least mitigating. So what we're talking about is what might happen. So it may not happen at all. Everything might go perfect and we don't see any significant impact on your businesses. Well, that is fantastic. Nobody wants that more than you all on this call, and myself included and Dan included. But what happens if that's not the case? You have to plan. One of the things you have to do is immediately analyze, I think, your direct exposure to failed or failing banks. Do you have money with those banks? Do you have agreements with owners who are relying on money from those banks to support their projects? You also have to revisit, I think now, operational and growth plans. Is it really the best time to expand your footprint? Is it really the best time to hire, expensive, non-essential staff? I mean, we're certainly not saying it's time to go out there and just lay folks off. That's not what we're saying at all. But is it really a good time to put money that you would otherwise have available to you to help sustain your businesses if things didn't go well? Is it really a good idea to use that money in ways that are not necessary for your business today? Can you liquidate unnecessary equipment? And can you focus on reducing overhead? These are things that we want our clients doing regardless. I mean, there's no reason to carry equipment that's not necessary to the work that you're performing. And there's no reason to not look at your overhead constantly and determine how you can streamline your operation to increase your margin by reducing your expense. And that reminds me, Dan, that you mentioned, and you might want to mention it again, about the timing of looking at overhead.
Yeah, I mean, something Ali and I have talked a lot about is we're not saying going and laying off people tomorrow, but what we are saying is going through the process of evaluating what things would look like if your revenue reduced 10, 20, 30%. What if your margins decreased by, the same percentages? What would your business look like? What would you need to do to your overhead? And just the simple act of going through that exercise can be very powerful in helping you have an idea of what you would do, rather than being in the middle of the war where bullets are flying over your head and you're trying to figure out at that moment what to do. You've already got 3 plans to consider, and you can start to make some objective decisions rather than emotional decisions, which are very hard in those time frames. And we all care about our employees. None of us takes our roles as business owners lightly and the responsibility we have to people. And so trying to do it at a time when you're not in the midst of that can be a very powerful thing.
Yeah, that reminds me, I think, Dan, you might have had a speaker at one of your seminars, but, the time to effectively reduce overhead is not the time that you realize you need to reduce overhead, right?
Yeah.
It needs to predate it by months, if not years,
Yeah.
right? In order to successfully integrate your reduced overhead into a successful operation, it has to be a gradual reduction, as opposed to, okay, well, next month it looks like we need to reduce our expenses. Well, that's not the way to do it. Nor is it a good idea to be putting yourself in a position to try to sell equipment that you don't need at a time when the market is flooded by all other contractors who are seeing the same thing right at that moment and thinking it's a good time to call my rep at Ritchie Brothers. It's a good time to maybe get rid of those 25 F-150s we don't need. Well, the reality is, if you're looking at it at the same time everybody else is looking at it, you're not going to get fair market. Well, you'll get fair market value, but it won't be fair. It'll just be market value. And that's going to be driven by the supply. And the supply is going to be much higher than it is today because folks are A, going to realize they got to cut down their overhead. B, they're going to try to deal with expensive debt. And a lot of debt is consumed with equipment. Right? How do we stop paying for things that we don't need? Okay, well, can we get rid of this equipment? Sure. A lot of times folks think, at least on paper, well, shoot, we might be able to sell this equipment. Not only will we be able to clear the lien, we might even have some equity in it. That may be the case if you're doing it now, but if you're doing it in the midst, of a crisis, not only may you find that there's no equity, but you also might find that your lender is not fully satisfied as a result of the liquidation. And it's just not an uncommon thing to see because we saw it a lot in 2011, 12, 13, and 14.
Yeah, that's a great point, Ali. And I think you mentioned something previously about cash flow. Can you touch on that?
Yeah. A lot of the work that I do for sureties, as opposed to the work I do directly for contractors and owners, sureties will call me and my firm to help them deal with a contractor in crisis. And that contractor, like I said, may have 10, may have 100 open bonded projects. And one of the things, our goal is to minimize the amount of loss suffered by the contractor and the surety as a result of, for whatever reason, that contractor no longer being able to support its operation and successfully complete those jobs. And one of the very first questions we ask, and it's a large team, it's a team of lawyers, accountants, so it'll be my firm, there'll be lawyers at the surety, they'll have amazing accountants and numbers folks. They'll have construction consultants, and they'll bring everybody into a room. And one of the first questions we ask of the contractor is, can you put together or give us your most recent cash flow? Tell us how you see this thing playing out. What's your spend next month, the following month, 3 months, 6 months, 9 months? What are your costs? What's your cash flow? And Dan, I think what you're referring to is our reality, that more than half the time, we might even get the question back that says, what is a cash flow? And that is part of the problem, I think. And it's not a coincidence that a lot of folks that are in that position don't know what a cash flow is, because it goes back to what Dan was talking about, right? I mean, in order to analyze where you are financially, to identify your risks, to mitigate those risks by making your operation leaner and meaner than it's ever been, you have to have an understanding of what you're cash flowing. You have to understand what you're spending, what you're generating. You're not going to be able to impact what you're spending until you know what you're spending. And you're not going to be able to plan for the future unless you know how much cash you're going to have available to you to make adjustments, right? So when Dan says, are you able to withstand a hit of X over this period of time? How can you answer that question unless you know what kind of cash you're going to have available to you, right? So, these are the types of discussions you have with your Dans of the world, you have with your outside accountants, you have with your bankers. Some instances you have with your insurance brokers. Certainly, depending on the what level of crisis you're at, you might want to involve your lawyers. It depends on really how much your lawyers are involved in your business. I mean, can they bring something to the table? I can tell you that probably most important, right? And as far as, as much as I would like you all to call me first, I think the outside consultant type that you have on your role in your Rolodex that knows most about this is going to be your Dan. And whether that's Dan or someone else, but whoever is in that position that has dealt with this before, who is dealing with bonding companies, banks, owners, right? I mean, that's the type of holistic information and advice you need in order to start thinking about this and getting your ducks in a row. Because that's the goal of this, is hoping that we're imparting on you the importance of getting your ducks in a row. One of the questions, Dan, that we've have come up and raised with us is, should we quote unquote tap our line of credit? We've got a couple $1 million sitting at our local regional bank. We haven't been using it. Should we wait until the bank makes an adjustment, terminates the line, restricts the line, or should we just go get that money and put it somewhere safe so that we know we have access to it? Well, that requires a lot of analysis. Is that cost of money worth it to you? Because it's not going to be free, right? With interest rates creeping up, you might be paying 7, 8, 9 points on that money. So how are you going to pay for that 7, 8, 9 points on $5 million or $2 million? Do you even have the money available to you to pay to do what we're talking about? Putting that aside, let's assume you do. Is the surety who you are relying on to extend you the credit in the form of bonds that you need to go out and get work and to be successful? Is your surety relying on a $5 million line of credit that has a zero balance when they're underwriting your next bond? Very likely so. Very likely so, right? Because the surety thinks, I think rightfully so, if you experience any hiccups or problems and your jobs are not paying for themselves, well, shoot, you've got access to that line of credit where you can go to your bank and withdraw monies and help support your operation. And then you'll hopefully pay back the bank when you get the monies in. But you'll do all of that before you're going to put your bonds at risk. And that's an expectation of the surety. So tapping of the line of credit is something that needs to be thought through, obviously, but also you need to consider the implications with respect to your bonding capacity. Cash is king, absolutely. But you have to think about whether or not going to cash is the right answer for you. And as we discussed, what is the impact on the underwriting relationship? What is the impact of all of this, really, Dan, on the underwriting relationship?
Yeah.
If I'm a surety underwriter and I go out and I do my quarterly visit with an account, and I see that these folks are on their own without being pushed or pressed, I see less equipment that's sitting in a yard. I see a lot of movement in the office, a lot of excitement. Folks are implementing new operational tools to streamline, become more efficient. I see an improvement in a margin despite the marketplace because, overheads being cut. Those are all things that people pay attention to. So,
and I think it goes to your point earlier, Ali, is that there are opportunities in this. Contractors, it's not all doom and gloom. There are contractors that manage well in downturns, and they either not only make good money, sometimes they advance their business because, and it don't mean just by growth. They improve their business and their surety relationship by demonstrating their ability to fly the plane in turbulence, to steer in difficult times. And a lot of this, these scenarios that Ali and I are talking about, I would encourage you to discuss with your surety agent, discuss with your surety as you become more clear on what some of these options are. We had contractors in the Great Recession that did tap their lines of credit strategically. They put it in an account, and it was not a problem for the surety because the money was still accessible. So these are things that, if they're communicated well, thought through well, that they can not only help you manage through this, but they can also improve your relationships if they're dealt with constructively.
Yeah, absolutely. So sort of the final phase of the discussion about mitigation risks has to do with protecting yourselves as contractors, given the fact that, pay if paid protection is not a protection that you have here in California, and you don't have it in several other jurisdictions that you may be doing business in. And so if you don't know what I'm referring to, so a pay if paid protection used to be that you could have in your subcontracts a provision that says, subcontractor, you're coming into this with eyes wide open. You know that I'm relying on the owner and the owner's finances in order to cash flow this job. And I'm not at risk, even though I'm the general contractor. And what we're going to agree to, subcontractor, is that if for whatever reason I'm not paid for your work by the owner, who's paid by a bank, I don't have to pay you. And that used to be a significant protection to our contractor clients, because you were effectively not at risk, or at risk in the event of owner default in payment. But what the California Supreme Court said, without a doubt, is that those provisions are not enforceable as a matter of law. So you can have pay when paid provisions, so long as you identify a reasonable period of time within which those payments are going to be made. But you're never going to be taken off the hook completely from your obligation to pay folks downstream because the owner and or its bank has failed to pay you. So that really puts you in a position that if there is a credit crunch and there is a lag, disruption, or termination or cessation of financing on your private works, that you're going to be the ones that bear the brunt. So what do we think you need to be doing as a matter of course? First of all, as general contractors, you probably already know who the lender is, whether that's as part of your, you learn that as part of your negotiation of your prime contract with the owner, or maybe you have a third-party disbursement agreement with some funds control outfit. You very likely know where the money is coming from on your job. If you don't, you need to. Okay, you must know who holds the purse in this particular environment. I mean, I'd suggest you probably should have known, or we all should have been paying attention to this all along. But the fact of the matter is, this is an issue that has just come to the forefront given current market conditions. So whether you have or you haven't, you need to now. In California, because for anybody, whether it's what we call the direct contractor, who's the general contractor, or subcontractors, suppliers, laborers, material men, everybody who wants to enforce their lien, stop payment notice, and bond rights on private works needs to preliminary notice. And that notice must be given to the lender. And because the notice has to be given to the lender, our Civil Code Section 8208 makes it a mandatory duty on the part of every general contractor to provide everyone who asks for it the information of the lender. So if we don't have it, you absolutely have a mechanism with each of your clients to send a simple 2-sentence letter. Pursuant to Civil Code Section 8208, we are very respectfully asking you for the name information, that is the name and the address of the construction lender on this project. Gather that information. What are you going to do with that information? Operationally, organizationally, I think you all should be tracking it. Every project in one of the cells in your spreadsheets, however you're keeping track of this data, you should just have a cell that identifies the lender. Why is that important? Well, if for example, if you had that and you were doing work in Northern California, like my clients do, and you could just punch in Silicon Valley Bank in that cell, search it, and you'll immediately know, okay, thank goodness we don't have any jobs that came up where we have funding being provided directly by that bank. Or here are the 6 that we had, 5 of them we're closing out, but shoot, I better call someone who's managing this sixth one because it looks like we're just about to mobilize. And we just need some information as to whether or not this is an okay job or not. But by tracking that information, you were able to answer that question within a few minutes and make a phone call the night you heard about the problem. Right? You didn't have to go and have someone go through all of your files, dig through files in your drawers, call every single PM, call accounting. Who's the lender? I don't know. Find out. Okay, well, point is, let's track it. We know we can get access to it. Let's track it from now on, really. There's really no reason not to. Here's a copy of the California form. Again, I think there is an equivalent form in most of the jurisdictions that you do work in. Since we focus on working in California, here's a copy of that form. That's the section that's highlighted where you input the data you receive as to who the construction lender is. Of course, you have other remedies. Let's assume banks fail. Banks fail, or there's a tightening that results in slow, maybe not just non-payment, but payment that's not satisfying you. So where can you look? You can look to other tiers, right? You can look to your contract with your general contractor client. You might be able to look downstream in some situations to your subcontractors if they owe you money for reasons, whatever reason, they caused some damage to you. I mean, you have to just look at your contracts and see, is that another source of payment for us on this job? So that if we have a bank financing issue, we can infuse the money that is needed on this job to make it a successful one for us, or one that we survive. Obviously, the property owner on private works has an exposure to you because you have a mechanic's lien right. So regardless of whether or not the bank has trouble or the owner, the developer has difficulty with its financing, the owner of the property, usually someone different entity-wise than the quote-unquote owner who's entered into the agreement with the general contractor, that property serves as collateral security for you and anyone else who improves that property. And so you have a lien right in California, and there's requirements associated with perfecting that right, securing it initially, and then perfecting it, and then taking the action necessary to foreclose on that lien. When times get difficult, leading out of the Great Recession, the lien right became an important right. Oftentimes, there's no other way for a series of however many tens of contractors, subcontractors, suppliers who did all of the work, put the work in place, topped off the job, got it built. Everyone's gone. Everyone's insolvent. Well, the property's still there. So the only access to capital was by enforcing lien rights. So it's something that you have to take very seriously if you don't already. Are there sureties in place? Are there payment bonds at every level? Anybody above stream, above you in the stream, you should be asking, is there a bond? Because if there is, it doesn't matter that there is a restriction or elimination of the financing from a bank. You can look to that bond and the surety that issued it to provide you with payment for the labor and materials that you furnished for the benefit of that particular job. You have insurance that might protect you in the event of some type of calamity. Again, you've got to contact your agent. Contact your insurance agent whenever there's any problem, because it takes you 2 minutes to say, hey, this is the problem I'm facing. Do I have any coverage for it? That's what you pay for, right? Because you never know. I've certainly experienced it myself personally, but more often we experience it with our contractor clients. Could it be that this problem that we're having that's in litigation, that we might have some coverage for it? Well, we don't know until we ask. So ask your insurance agent, is there any type of business disruption insurance you have in place that might be able to assist you in the event you come across one of these crisis situations? Have you done what it takes to look to the federal government to get whatever you can that you're owed under ERC? I would hope that most of the folks listening to this have already said, they've already taken advantage of that opportunity and submitted their claim for ERC for whatever time periods they could submit those claims for. We have had multiple situations, even in the last quarter that just passed, that's actually passing as of today, as we speak. We have had a handful of situations of contractors in distress and not having the financial wherewithal to get jobs done. But those contractors had yet to apply for ERC. And even though receiving those tax credits back from the government takes some time, well, at least in those situations, we know that there are, in these cases, millions of dollars of capital that nobody was accounting for, that is ultimately going to be there to help offset loss exposure. So just make sure you've done everything you can by talking to your in-house accounting folks, but also to your CPAs, and determining whether or not you have access to some of that federal money. The contract terms themselves, that we'll talk about very generally, because they're all going to depend on the particular contracts that you're dealing with. But there's certain things we know are in your contracts. This concept of requesting an adequate assurance, and what does that mean? An adequate assurance is when you're really, the law thinks of it as you're scared. You have some insecurity. I wonder if there's enough money to finish this job. Well, the good news is, under the AGC prime contract agreements, under the AIA documents, under some, not all, subcontracts, the lower tier party is allowed to ask for some type of confirmation or assurance that there's sufficient funds available and committed for the entire cost of the project. The AIA talks about it as, provide me reasonable evidence of the financial arrangements you have in place to pay for this job. The right is first available to you at the very outset of your job. Very reasonable and commonplace to ask, okay, tell me more about the financing for this job. Okay, great. What we're going to see now, I think, is implementing these contract terms during the course of construction on a job, which terms also provide you with the ability to do if you have a concern now. Word hits the street that the developer you're working with has a relationship with a bank that is teetering. Okay, well, this provides an opportunity to start asking questions and gathering information. The right to stop work is a really critical one. It's a contractual right most of you will have. In California, for our general contractors, it's a statutory right under Civil Code Section 8830. And what's critical here is that whether by contract or statute, there's a recognition that you don't have to wait forever until you stop working. You're required to wait long enough to basically determine if there's a really significant problem with owner financing, such that 35 days have passed since the payment was due, meaning now we're talking about 60, 75 days from when the payment was due, and it wasn't due likely for about 30 days after you submitted your approved payment application. Depends. But the point is, whatever that period of time is, whether by contract or by statute, everybody recognizes that you're not required to keep your people out there and continue to work if you know that there's a problem with financing. And one thing that I think came up before and it'll come up again is, well, but I thought you lawyers always tell us never walk off of a job. Yeah, that's true. First of all, it's not never, but more likely than not, I think you'll be told, finish your work, fight about it later. But that's when there's a dispute with the other person you're contracting with, right? That's if there's a dispute as to who's responsible for the delays, whether or not you're going to get compensated for your loss of productivity. Those are disputes. This is different. If a contractor calls me and says, we know that there's no more money on this job, my immediate response, I'm not providing this as legal advice to you. I can tell you my immediate response is, what are we doing tomorrow or tonight to demobilize and to make sure we're not spending any more money? But we better be right. We got to know that there's no money there. But let's assume that in that fact pattern, I'm told the money's gone. Well, we don't want to be building for someone who's not going to pay us. You know, that's how we go from taking a job that maybe breaks even, loses money, to digging a hole for ourselves, that one job. And you would be surprised if I told you how many instances we have seen one bad job sink an entire otherwise successful company that has been doing business for decades in this state. And the fragility of companies is really tied to what Dan was talking about, right? Can you withstand a hit? And if you've got one job that you're continuing to pour money into, your labor, your materials, and you're not going to get paid, and you're not able to make up for that loss in some other way, then now you understand how one job can result in such a catastrophic result. So it's not just like it's one bad owner and the personalities didn't jive. No, it's the act of taking all of your good capital and throwing it into a bad pot without any ability to ever get it back. And depending on your balance sheet and your access to capital, that'll really drive how much you can throw into that pot without suffering an extreme effect. You also have, obviously, the termination right. The termination right belongs to you as the contractor for cause if you're not being paid. And then the owner has the ability to terminate for convenience if there's issues with funding or financing, which is the responsible thing to do. Owner encounters a problem with financing, terminates the job for convenience, make sure you're paid for the costs incurred through the date of that T for C, and doesn't allow you to get out ahead of it so that you as the contractor is taking on that additional exposure or hit. And then, you know, is there a force majeure type situation where there's a government act that takes place that may give rise to some type of contractual remedy that you may have? We'll spend not a lot of time on this final portion of hedging risk exposure, but it is something I'd like for you all to become aware of, because this is a statutory provision that I would say 95% of my contractor clients and 95% of owners that I deal with are simply not aware of. And so what happened is we talked about the pay if paid, the prohibition of pay if paid provisions under the Supreme Court's decision in the Clark case. Well, because those provisions were now unenforceable and the contractor is placed in that unenviable position of potentially having all of those downstream obligations, even though it's not getting paid by the owner, the AGC and others in the contractor lobby got to work, and the legislature enacted what's referred to as security for large projects. And that's under Civil Code sections 8700 through 8730. And basically what this is a requirement that owners on what's called large projects, which is all jobs exceeding $5 million. And that, as you all know, that's no longer really a large project in California, but take it for what it's worth. For all jobs, certain exceptions for certain owners, publicly traded owners that have financial wherewithal that is so established that they don't need this, but those are exceptions. So for the most part, on projects exceeding $5 million in value, the owner is required to provide security. That security takes the form of a payment bond, a special payment bond. This is a payment bond issued by an owner. Usually we're talking about bonds that are issued on behalf of contractors for the benefit of the owner and those that are working for the contractor. But this is a payment bond that's issued on behalf of the owner, or it's an irrevocable letter of credit issued on behalf of the owner with the general contractor as the beneficiary, or it's an escrow account. And what goes into this security? It's 25%. 25 or 15%, depending on the duration of the job, of the overall value of the project. So if you have $100 million project that you're building, the security required for that job is $25 million. And the idea is you don't need 100% of security, because what really the legislature is attempting to protect you against is what we talked about. It's that second, third, and fourth draw, right? It's, okay, after month one, the water, we can kind of see it. It's a bit murky. There might be some blood in the water. Month two, okay, we got a serious problem. By month three, we're expecting we're not going to be on this job. We're going to figure it out. Let someone tell us how we're assured that there's enough funding, but we're not going to keep putting money into this job. And so the reason the security is only 25% is because there's an expectation that you're not going to perform the entire job knowing that there's no funding in place, but the protection is there. And so if you ask for this, which I think most of you are entitled to ask for on any jobs that you have any concern, you don't necessarily have to go ask for it on every job, but you have the right to. But if you ask for this security and the owner tells you it's not going to provide it, what this does, it provides you with a separate and independent basis to suspend your work. You can just say, okay, we asked you to do this under the statute. The time has lapsed, after which you've told us you're not going to provide it. We're not going to work. So that could potentially lead to a fruitful discussion as to why they're not providing the security, because quite frankly, they should be able to provide the security if the financial framework of the deal is still healthy, right? Situations in which the owner is not able to procure the security is probably a red flag for a broader or more deep financial hole that the owner might be in that you're not privy to. So the discussion might lead to information that is of benefit to you. Finally, we added this really for owners and developers because they too have to adjust, right? The owners and developers have to expand their circle, expand the circle of folks they can go to access capital and get liquidity. So, if they had all of their eggs in one basket and that basket is crumbling or has crumbled, and now it's more important now than ever, really, for them to start looking at different sources. We encourage them to pay for the surety bonds, the couple of percentage points for premium. Yeah, no one likes that because it impacts the bottom line as to the return on an investment. But look at that. Look at the security something like payment bonds would provide in the event that the owner loses financing, but is required its general contractor to obtain payment bonds. Well, at least all of those lower tiers have somewhere else to look. And they can probably look there before foreclosing on the property. And they can probably look there before filing multiple lawsuits that are going to tie up that property and that project for 5 or 10 years. We also encourage our owners to know their rights to terminate for convenience. And finally, what we do is we try to convey to them that now is really, really a critical time with respect to their relationships with you as their contractors. Because if there is a contraction, if there is a credit crunch, and if there is a migration of contractors that are leaving private works to public works, it's more important than ever for the owners to really further develop their relationships with their trusted contractors so that they know that they have access to those contractors when they need them. Because if they don't foster those relationships now, and there is the migration out of the private market into the public market, and there are just less contractors available to do the private work, then if the owner has to go out and start getting competitive with the marketplace, it's I think expected that the pricing is going to increase. It doesn't make sense otherwise, right? The supply is going to be decreased of available contractors, so the owner's cost of construction is going to improve. So we really do say now is the best time to treat contractors well and to communicate openly so that everyone's on the same page about what is to come and how they're going to deal with it.
Thank you, Ali. That was excellent. I want to thank Ali for joining me in this presentation today, and we hope all of you have found it very valuable. Ali, if they want to get in touch with you, can you let them know your email?
Sure. So it's on the first page of the slide. It was AS, so it's my first initial and last initial.
Oh, perfect. Thank you, Ali. That's awesome.
Well, I didn't know the slide was there.
I didn't either. It made it easy on us.
Yeah, there you have it. Then we have both my and Dan's emails, both of our websites. It's quite a bit of information at both of those websites. I'd encourage you to reach out to me directly if you have any questions about what was presented today, or just generally anything that you all come up with that you'd like to kick around a bit. Unfortunately, I enjoy talking about this stuff, and I hope that you can tell from our presentation that Dan and I are really doing our best to try to get out ahead of this as much as we can, because we want nothing more than for your firms to survive and really thrive and succeed if, in fact, we face anything similar to what we did after the mortgage meltdown in 2008.
Thank you, everybody.